Welcome to the MHP Exchange, where the riches are in the niches. We'll show you how to invest your way into mobile home parks with real strategies, tips, and behind-the-scenes know-how to grow your cash flow. Stick around. This is where smart investing begins.
So you downloaded another episode of the Mobile Home Park Exchange podcast, and today's episode is one I've been looking forward to for a very, very long time. Our guest today is actually somebody who had me rethink some of the ways that I do my business. You know, I am one of those guys that for the past 25 years, I love going to conferences. I love hearing from different real estate operators, professionals, and what they do and how they do it. And my next guest was one of those speakers who if he's at a forum and I'm there, I want to make sure that I'm in attendance. But more importantly, I had an opportunity to meet him after one of the forums where we sat down and I really had a chance to talk, and he was even more of an impressive individual. So Nathan Jameson from Arcs Capital, how you doing today?
I'm great, Frank. Thanks for that really kind introduction. I too have been really looking forward to this.
So, and I'm going to jump right in because there was something that you said a while back at a conference that I attended that really stuck with me. And it was in your approach on how when you acquire a distressed, mismanaged, operationally deficient property, and how you look at moving lot rent to market. And you were one that says, and I think you said, look, I ripped the Band-Aid off right away and I go initially to market. Explain to me that philosophy and kind of unwrap a little bit of your thoughts behind that.
Yeah, I'll probably be a little more nuanced here, Frank, than I maybe was on the panel. Sometimes, the contrarian, blunt contrarian approach on a panel is a little more effective. That said, I mean, we absolutely do believe in ripping the Band-Aid. And I think my approach to that is really based on what I say we believe, and what we actually believe is we are in the business of providing attainable housing that is sustainably affordable beyond my lifetime. And the biggest problem we have in manufactured housing among, let's say, non-institutional properties is the mom and pop owner, the smaller owner, or even maybe they own a few communities, who refuse to raise rent to market, because the threat is that that property becomes devalued and will ultimately be purchased and cease to become housing, because you cannot maintain it as affordable housing. You can't repave the roads, you can't fix the sewer systems, you can't bring in new homes, can't pay increased property taxes if you don't raise rents to market. And so the threat is that that property will become a data center, an industrial complex, new townhomes, new apartments, a grocery anchored retail center. And I really believe housing is America's most desperate real estate need. So what we attempt to do, Frank, is really be prepared to put our money where our mouth is when we buy a property where the rents are substantially below market. And that means, on day one, I want asphalt trucks showing up, and I want to be putting down new blacktop. I want the sewer, pipe company showing up and fixing the long, problematic clogs that have existed in the system. I want to be ripping out old and dilapidated vacant homes and bringing in new homes, like on day one, so that when we have that rent increase, the residents, maybe for the first time, are experiencing a pride of ownership in the community, a confidence about the place that they live, that they haven't frankly experienced. And that really, when they get rational about it, they would trade higher rents to have that level of security and sense of pride in the community.
So, and I'm going to unwrap because there's a couple of things that you said there that I thought were really key. And one of the key memorable points I got from that conference too is that it was about effective communication with the residents going into day one. So yes, day one, your rent is going to go up, and to market, right? But you're effectively communicating that message beforehand that if this doesn't happen, then the alternative was that somebody else is going to come in here and you're going to be forced to move. And if you
That's right.
don't want to move, and we don't want to move you, then this needs to happen. But additionally, you're following that up with the fact of what you're going to do to add value to their lives, right?
100%. And I'm not, let's be clear. There are people in the community who will not be able to afford to stay. So the other thing we do, Frank, is, moving to market. What we've done in the past is, let's say you have a $200 increase to get to market. What we'll do is we'll make our contract rent $200, but we'll phase in that when they're actually paying that through rent credits over the course of 6 months, over the course of a year, to very intentionally telegraph. This is where it is. This is the timeline over which your rent credits will be reduced so that you're paying that. So you can adjust your budget accordingly. You can plan to sell. And let's just say for all our operators out there, you can't do this in a tertiary market where there isn't demand for your housing type. But in markets where there is significant demand for the affordable housing and manufactured housing, I think we owe it to our residents, we owe it to ourselves to telegraph where this is going and give them a chance to harvest the equity in their home. That's a conversation that doesn't happen among bureaucrats and politicians. Is most of our residents own their home outright. And so in markets where I operate in the Northeast and the Mid-Atlantic, these residents have significant home equity. And if they choose not to or unable to pay the increased rent on a monthly basis, they are able to sell their home and harvest tens of thousands of dollars, if not more, in the sale of their home and make another housing choice that has a lower operating cost.
So you're still doing it with that personal touch. And I will say, part of the challenges that we faced and why this had us relook at what we were doing and how we were doing it. Part of the challenges that we faced when we first started this 10, 12 years ago, the valuations of of the dirt allowed us to say, hey, we're going to go in, we're going to show the residents, number one, all the improvements, and then they won't have a problem paying for the increase. The challenge has been, to your point, because other people have come in and started to say, well, there's a higher and better use for the property, that's forced valuations up, and it becomes financially, there's not a runway to say, I'm going to invest all this capital for 12 or 18 months and then defer that increase, because then you're always playing catch up, right? And that capital has a cost. So one of the things that we've started implementing is, if we know we need to get to market, we'll still do a stepped up process, but we'll begin the process before we close and have the current owner send out the increase. In my conversations with the owner is like, listen, you could be the bad guy on the way out. I've got to be the good guy on the way in. And then I can make my improvements. And if by the end of year one, I can get to where I need to be, and you could take some of it before we take possession, then that helps us along the way. And when the current owner looks at it, they want out. A lot of times they didn't want to raise the rent or get it closer to market, even though they weren't making the work, but because of maybe personal relationships they've had with people over time, but at the cost of, to your point, roads not being done, hazardous conditions in the property, infrastructure that's old, dated, and failing, because they don't have the capital to do that. So because the cost of everything is so much more elevated now, and it's there to stay, you have to figure out how to make these properties more viable.
Yeah, well, one of the things that I think we talked about home equity just a minute ago, the reality is the work we're doing in these properties is increasing the home equity that these residents have. And the failure to maintain the property is reducing the home equity. And so there's a trade-off between, like, do I want a home that's more valuable, or do I want to pay less lot rent? And you can't have both. You just can't have both. And so we really believe in investing in these properties. I want to drive by them with my family and say, like, look what we did there. And we have a number of properties we've been able to do that. And I get really excited when we're able to buy a property at the right price that allows us to make the improvements and raise the rents to where they should be, and where you just experience the residents being thankful for safer community that they're proud to live in.
So do you think, in part of your communication with the resident, I think what makes it really effective, like your pathway into this space was really from the entitlement and development side, right? So when you're
Yes.
making the case, there might be a higher and better use. You're not saying, quote unquote, saying it, you've actually done that, right? And I think that's from a lot of the operators who I've met and spoke with, that is a atypical way to get into the manufactured housing space. You were in development, you were in single home development. Does that change your thinking on this a little bit?
Yeah, I mean, I don't know if it changes my thinking. I think you're right. It makes it different. I don't know. I can't remove the lens that I see the world through because my, first almost 15 years, 14 years in real estate was through the lens of raw land acquisition, development or entitlement permitting and development and, full on home construction. Was fortunate to work and be a partner in one of the largest privately owned home building companies in the country. And, $1 billion of real estate sales over a decade or something. But I think as a result of that lens that I grew up with in the industry, I look first, I see land. Okay, there's land. What is the highest and best use for that land? And if rents are not at market or can be quickly brought to market in a manufactured home community, then there is a higher and better use that is not that. Case in point, I think will help here. We bought a property in Delaware in 2021, 72 site mobile home park near the Delaware beaches. And unlike most mobile home parks, this was permitted, entitled, and constructed with 72 individual lots. And we're used to, if there's 72 lots, it's one property and you've got, maybe building setbacks, but it's one parcel. This had 72 lots. Well, I quickly put my hat on and said, well, I'm going to call the national builders who are active in this market, and we're going to see what would they pay me for these finished lots that have utility connections, and we can move the homes out and build single family homes. And their price was meaningfully higher than what we were paying per lot for the property, Frank. But we saw a path raising rents to market where we could make the property even more valuable over a reasonable period of time. And so, absent that, somebody probably would have come online and cleared out those homes. But we've been able to maintain the highest and best use, we think, because rents are at market here at the Delaware beaches for mobile home parks.
And still be able to maintain an affordable housing supply inside of that market, because if
That's
it
right.
shifted to home builders, especially if you're talking about a beach area,
That's right.
I have to believe the traditional stick built house would be significantly higher cost or higher cost entry price than the housing that you're providing now. And that's one of the keys of this sector in the space. You are providing a key component of affordability. And from that development background, and we've had conversations on this, and I think, you do a lot of infill in your communities, correct?
We do.
Okay. And I've had this conversation. Infill is probably the most difficult, challenging part of this space, right? And I think any operator that focuses in on it, and it hones in on it, right? There's a level of complexity that most people from the outside don't realize, right?
Yes.
And case in point, you take a look at Sun Communities, UMH, billion-dollar companies. They activate between 1% and 3.5% of their lots, and they're probably two of the biggest, operators in the space, and they're only operating, 1 to 3.5% of their lots every year, while we're having an affordability crisis in this country. How do you handle the infill, and then how do you handle your your infill process, and then how do you handle your sales process? Because you've kind of touched on it a little bit, but how do you handle that in house?
Well, I will say at the outset, it's a fast moving, changing process. But again, I go back to my home building experience. Is we were successful in the home building world because the home building industry tends to be fairly slow moving. I mean, the only real estate industry that's more slow moving than traditional home building is manufactured housing. And by that I mean, the typical way a home builder approached, say, the Great Recession was just, we're going to wait it out. Well, waiting it out is death in business. You've got to innovate. And part of that innovation is boots on the ground, ownership on the ground, um, frequently. I mean, every week, you've got to see what's happening. You've got to be interacting with the prospective customers, with your existing customers who will chase people out of your community if they're not happy. So I just start with, like, we believe you have to be super engaged. I mean, I had someone told me years ago about a property. Oh, don't worry about that. It manages itself. Nothing manages itself, and of course there's all these, influencers marketing, mailbox money and so on. Mailbox money is a recipe to lose your money. You've got to have a sponsor and an operator who is really actively engaged. So start with that. From an infill perspective, what we're doing today is, our corporate structures, we're self-managing these properties. We've got a lead on our sales and operations who's tremendously experienced in the industry. And then we have regionals and management support underneath him. And then we're using AI in a significant way today. I mean, if you'd asked, we had this conversation a year ago, Frank, I would say, well, we're doing Facebook ads and, somebody calls in. If we don't get the call, we try to call them back. I mean, today we are employing AI agents for answering, for even for speedier approvals of leasing applications and so on, for homes. But if I back up just a minute here, like, there has to be a home there to deal with the leasing applications, to deal with the purchase and marketing of that. So getting the home there it's a significant challenge. We have a dealer's license. I suspect you probably do, and many in the industry do. So we're buying homes wholesale prices from the manufacturers through the dealer's license, bringing those in and setting them. Probably the most misunderstood thing to me in the industry, Frank, is what is the cost of setting up a home? And of course, Wall Street says $20,000. Well, tell me what you get for $20,000, and tell me what market it's in. In the Northeast, I probably can't set a home for under $35,000.
Wow.
And I mean, like, I can move somebody into that home. So it has a air conditioning unit if I need it. It has a shed if I need it. And it's got a sidewalk to the door. I mean, a lot of people's set costs don't include, a driveway, a sidewalk, and a landscaping package. And all that comes from, like, my home building background is like, okay, we're building a home here for Mr. and Mrs. Smith. What comes with it? And we really try to really refine that. So I would say our marketing process is continuing to evolve. The AI component here, Frank, is really helping us be more responsive in real time to people who are looking for our homes and our communities. And that's proven to be very effective.
Do you, and that having that home building, and here's where why I'm asking that question. Having that home building experience where you're building in a development, right? And then
Yep.
having that internal sales process, right? Because as a home builder, you're obviously making your money on the transaction of exiting each one of these individual units. Do you think that gives you a little bit of a advantage? Because many people who become operators in the space, they don't, even while a home builder is not a sales person, you understand the component of sales to extract your equity or value from a project and understand the importance of that component. Do you think that gives you an advantage, but gives you a different insight into
Sure.
what you need to be successful?
I think so. I mean, I'm thankful every day for that experience. There's a lot of really good, um, I'll say carpenters, framers, tradesmen, drywallers, who are not good home builders because they can't actually exit the home that they built. And so same thing here. There are people who could bring a home in. I remember having a conversation just, maybe 12 months ago with one of the largest institutional real estate investment firms on Wall Street. And they were backing a sponsor to aggregate mobile home parks. And I said, well, what's the biggest takeaway you've had? This is like they're 3 years into their process here. And I kind of knew, if I named the name, you would know what I'm talking about. I kind of knew that wasn't going great. And the Wall Street analyst looked at me and he said, it's a lot harder to fill sites than we thought it was going to be. And you got to, somebody on Wall Street, you got a finance bro in a vest who's doing numbers on a piece of paper. He doesn't know why that home hasn't sold. Well, the home hasn't sold. It hasn't been occupied because you can't get Atlantic City Electric to return your calls to get the utilities turned on in that home. And you had it ready 6 months ago, but you can't get the union electrician to show up and like flip it on. So navigating those kinds of things, and if there's one of those, there's a million. That I just frankly, I came to this business with that experience that I think has been super helpful in terms of speed and execution.
And I think a lot of people come into this space, and to your point, like the Wall Street, let's look at a spreadsheet, and they look at sales as an afterthought because they figure affordability will equal easy infill.
Yes.
And they don't realize that sales is a process. And in order to effectively market, right, and then to touch that customer multiple times to get them to want, even though it might be the right decision, but get them to say yes and commit is it is a process. And without that sales process in place, you go into areas where there's an affordability issue and you find vacant lots sitting in communities that would definitely fill in homes. And for us, I look at the infill as two-legged, right? My partner, Eric, handles the logistics of bringing in the homes, which is, it's a job all in itself.
Yes.
And then from my background being in real estate sales, I believe that helps us where we can have that focus and don't just rely on, hey, the manager will show it and then they'll sell it because it's the best value in town, right? Like that doesn't work. And we created a process where 7 touches before the prospect even gets there, right? And then how are we doing the handoff and how are we introducing the next person? And these little things improve the application process and the quality, I think, of the person going in there because they feel more vested into the community. But I think it's something that gets overlooked a lot of times.
Well, you're spot on, Frank, and I think we're talking about infill here, and infill is critically important when you're doing a value add community where your pro forma counts on filling sites. One of the things we didn't count on, I mean, I didn't know enough to know when you're buying a property is you're going to turn over, particularly if you're moving rents toward market, you're going to turn over a meaningful part of your existing resident base. And we, fortunately or unfortunately, we were able to buy a number of properties years ago where, frankly, the prior management had not done a good job of maintaining tenant quality, credit quality. Maybe they knew they were going to sell and they were stuffing the rent roll with live bodies, but they really didn't qualify from an income perspective. When we buy these properties, not only are we infilling vacant sites with new homes at market rents and higher credit quality, but we're also getting the chance to turn over existing residents who then are backfilled by higher credit quality, better tenant quality, which improves the quality of cash flow from the property. And quality of cash flow then enables that property again to continue to be sustainable as a housing for the long term. And we just, I guess I went there because we're talking about sales and marketing, but a key part of sales and marketing is helping residents who are selling their homes find a buyer for their home. Because ultimately, if your resident has a hard time selling their home, that problem will come back to you. You might say, well, I don't own the home. It's not my problem. They're paying rent. Eventually, they will not pay rent. Eventually, you're going to have to go through a legal process. So making sure you've got a more liquid market in your community to help your residents sell their homes, I think is tremendously valuable.
So almost leads me into my next question, because that, in doing it the way that you're doing, you talk about one side, people rent stuffing, trying to get as much income, even though if it creates higher turnover, they don't care because they'll look at it as, well, enough of it'll stick and I'll get it through the wash and I'll get the next person, and it just becomes another cycle. You have more of a longer term, right? Might
Hmm.
take a little bit longer in the beginning to get set up until you get that machine running, but kind of a longer term approach to that. And do you look at that as how you're aligning your capital, like what your vision with the capital inside of your vehicles, whether it's through a fund or a syndication, is that why you're able to look at it not from a instant gratification so much, but more about a durability factor?
Yeah, it's a great point. I hadn't thought about it exactly that way, Frank, but I think I started with, what's the right thing to do for these properties, and I aligned the capital structure with that. And again, that comes from some of my background in home building and just learning the business. Is I always believe that the right business idea should drive the capital structure, not vice versa. So many people try to shoehorn their business plan into the capital that they can get, whether it's debt or equity or mezz. And I think the right business plan should drive the capital structure. So we view our properties and our funds as long-term holds. I'm the largest investor in all of our funds, the largest single investor. In some cases, I've been more than 50% of the funds. Um, but when I entered in that way, and I said to friends and family and an expanding group of investors, I'm interested in holding these for the long term. And my perspective on investing is I want to make an investment. I want to get my capital back in 3 to 5 years through refinancings or on a fund level, maybe through some selective sales. I want to have my capital back, continue to own these assets, and generate regular cash flow. And frankly, our investor base said, you know what, I'm interested in that too. And so they've invested with me and alongside our team in these. And I think, in fairness, that's allowed us to maintain a longer term perspective on these, where certain capital structures and certain limited partner, particularly institutional partners, they're running on a 5 to 7 year clock. And we are sometimes making decisions, whether it's, our CapEx schedule or, even like looking how fast are we going to fill sites. We'll take a longer term approach than, hey, let's jam in 30 homes here and let's rent them. Because you know what? We got to cover the debt on those homes. Let's rent them. I'd rather do 12 homes a year and sell them.
Nathan, why was that important to you to be? Because what you're saying there is, from a syndicator operator perspective, it's unusual to find somebody who is not only going to be the GP, but also be the largest LP in their own fund or syndication, right? Why was that important for you to do that day one?
Yeah, I don't know that I was consciously thinking at the outset that we were going to take the trajectory we've taken. Just at the very simplest level, Frank, I needed a place to invest, and I really liked this space. I knew housing. I kind of had a sense that my perspective on this industry was a little different than the people who'd been around for a while, and having the capital then to invest, I was able to deploy it in opportunities that I thought were pretty exciting. Now, we were both doing this a decade ago, and those opportunities looked a little different a decade ago than they do today. But there's still opportunity. And so, I think then as we were successful, frankly, I felt convicted that I wanted to share the opportunity with my network, many of whom did not have access to these kinds of investments. And one of the frustrating things, and I'm off on a goose chase here, Frank, but like the reality is, the institutional investors are often crowding out, the millionaire next door, the 401k millionaire, the accredited investor who really lacks, access to the kinds of opportunities we can provide them. And I would say I feel pretty strong conviction that one of our values and goals as a business is to provide those folks these kinds of opportunities.
And look, we all are part of the, I mean, I guess we see the same offerings, right? From people, like every deal is a 20% better
Right.
IRR. And it sets these expectations, I think, with investors that are, and listen, there was a brief period where I think anybody could have probably got a 20% or better IRR, right? So there was that
Yep.
with
Yep.
low rates. But how does that conversation evolve with you, especially when you're looking at some of this? Is that the metric that you're looking at? Is it more of a, let's look at the multiple that we're going to get over time because this is more of a long-term durable asset, and we're looking at this over, for the resilience and the cash flow? Like, what's the lens that you're looking at when you're acquiring one of these
Sure.
properties, or does it change based on the asset itself?
Yeah, so we've been buying mobile home parks and RV parks in funds. And as an investor, I like the fund model because of the diversification that it affords people. Now, there's a group of folks out there who say, yeah, I want to pick the deal, and I only want to invest in that deal. I don't want a blank check. And we've been able to counter that a little bit because, frankly, I'm funding a lot of the upfront purchases to seed the fund, and then we've got kind of a base of assets, and then we're raising into those and continuing to purchase. But I would say um, what we look at, and this is coming back from knocking on farmers' doors, Frank, from a land perspective. I look at what should this property be? That's number one. Is this the right use for this property, and can I make it better over time? Number one, because I don't care what the returns say if I don't believe in that. There's a lot of real estate in this country that should not exist, but somebody built it one day, and no matter how cheap it is, I may not be able to get the right return. So do I like the asset? Number one. Then I would say we're toggling three key categories. IRR, multiple on invested capital, and then I thought, cash on cash, right? Those three we're looking at. All right, we'll take a little lower IRR for a higher cash on cash and a longer term hold with a high multiple. We might take a higher IRR with a little less cash up front, and that when we blend that together, we still think that there are, in the way we're investing, there are opportunities to get 12 to 15% annualized IRRs and 2 times your money over a reasonable period. I would say that reasonable period is 7, even as long as 10 years, but say 7 to 8 years. And then we're just kind of open kimono. Hey, this is who we are. This is what we've done. This is what we believe. This is what I'm investing. And I would say if you want to put out $200 million in a year, you can't do that, right? But we've structured these funds to date at around like $25 million in equity.
Yeah, and I think what you said there was, as I look at that, it's so important, especially in setting the investor expectation and understanding of what this asset class really is and what it can provide. I was having a conversation with an investor recently, and he said something that struck, and he was like, "Well, if I took this money and I put it in NVIDIA, well, it's the wrong concept. And if that's your concept, this isn't right for you, because yes, there could be a higher multiple there, but there's so many things that could affect that investment that have nothing to do with the actual performance of the company, right? Here,
Yes.
this is the business. The business we're buying, essentially a failing, you're acquiring essentially a failing business that we've got to recapitalize, reinvest in, and reinvigorate. And then that's going to take some time. And in doing so, you're going to lose some of the existing customer base. You're going to be bringing in some new customer base, and that takes some time. But then when it's set, you're going to, with some pretty good clarity, be able to say what this is going to look like 3, 4, 5 years out. And look, nobody has a crystal ball, but you could, by the time you reset a property 24 months, you kind of get an idea of what that property should look like or should be able to return to you over time. And I think that's where the expectations for the investor is to realize NVIDIA is great. I'm not saying don't own it, but that's not for this portion of the portfolio, right?
Yeah, FOMO is not a great investing strategy, right? And I think you know we're interacting, you and I, with a number of people, or competing with a number of people who don't know what the world looks like when it's not up and to the right. And it's been up and to the right, frankly, since 2010, right? It may have started out like this, but it was still moving up and still moving to the right. And take COVID out of it, we really haven't had a recession. And we've got a lot of folks, in my opinion, who, in the old Buffett adage, the tide's going to go out and we're going to see who's swimming naked. Now, because we're an industry where rents have been below market and they've been able to kind of chase their increased expenses or their bad pro forma by raising rents, I think our industry is frankly hidden some of that, inexperience more than, say, multifamily. But I do think, and I would just say, like, I am super concerned about the overall economy because of, let's say, this private credit. Everybody's reading private credit headlines and so on. But to me, Frank, it's the financial innovation that mirrors what was happening pre-08 that we're seeing. Every day there's a newfangled vehicle that really is someone on Wall Street going, well, if we slice it a little more, and what's not known is kind of how far the dominoes go in that. Because of that, I'm a hard asset guy. I'm a mobile home park guy because guess what? If the economy does this, well, we have more demand for our housing. And folks will say, oh, it's a K-shaped economy. Your residents are going to have a hard time. Guess what? We're going to have more people who want to get in than people who need to leave.
That's a great point, Nathan. And I think, not to date you or date me, but I went through the Great Recession in real estate. So, and I know you have as well. And going through that experience from 07, 08, 09, to that, I think it changed your focal point where you realize, hey, it's not always going to be easy, good, right? And there's going to be challenges. There's going to be times where you have great deals that you just can't close, right? Because for one reason or another, that has nothing to do with you. It's just not going to happen. And one of the things that attracted me to this asset class post that was, to your point, if something bad happens in the economy, this is the hedge to that, right? More people
Yes.
fall into this bucket. You're the most affordable housing stock. And ultimately people have to do a couple of things, right? They have to breathe, which is, they have to eat, and they have to have a place to live, right? And you're providing that base affordable housing. I'm going to touch on this, and I wanted to touch on this because I know this is important to you. And in your philosophy and how you invest, but you are a faith-based investor, right? Do you want to kind of like unravel a little bit of that, or how that kind of makes you look at what you're doing or your projects maybe a little bit differently?
Sure. Yeah. Thanks for the invitation to do that, Frank. I mean, at the highest level, um, I named the company ARX because ARX is Latin for fortress. And yeah, I was going through a difficult season about a decade ago, and I tend to wake up in the morning and have like a daily devotional. I'll read some scripture, and at that time I was really living in the Psalms in the Bible. And over, whether it's David or the other psalmists are saying, the Lord is my fortress, the Lord is my refuge. And so, I thought I was going to name the company Fortress Capital because I wanted to honor the weight and the strength that I got from reading those verses. Of course, Fortress Capital is taken. So I said, well, it's so important to me. I wanted to like have a way to honor that. And so I found that ARX is a Latin derivation for fortress, the Latin word for fortress. And quite simply, ARX, it was called the ARX in ancient Roman times. It was effectively the citadel in a Roman city. And it would have been like the point of the most secure, safe place point of last retreat, and I thought, that fits. It fits personally for me. It fits in terms of how I want to invest. I want to be super secure, and I would say that what I'm learning, the journey I've been on, is how does that feed into our business? How does that feed into how we think about things? And I'm glad to say that, even some of the conversations we had about raising rents and how do we go about that, I think that's really informed by my belief that providing housing for people who need it is a critical value, and it's important to God, and we're not perfect for sure, but we want to have a culture that honors every person that we come in contact with as someone who's made in God's image, and may have different values, but I believe we were all made in God's image, and how I conduct myself on a daily basis, whether it's personal or work, I don't really think there's a divide there. It really should inform how we do things, the integrity with which we do things. So I'm proud of that. And you know what, frankly, feel like it puts a big target on my back every day because I've got to be accountable to that. I'm going to go on a podcast and say that, then I'm going to be accountable. I got to be able to make sure that we can live up to that as a team.
You know what I love about that too is, and one of the things that we look at, or one of the things that drives me is you want to make sure that you're creating win-win-win situations, right? And I don't think that if you're being guided by faith, and then I know that been put in this situation for a reason. The reason is I've got to find a way to create a win for everybody along the way, right? I've got to add value to the people, to the communities, and to the partners that I'm involved with. And how can I bring that out, right? Is that sharing the story of what we're going to do and getting people to allow me to do that, right? To allow me to improve that community, and then sharing that story with the people in the community, making sure that they're getting value out of it and they're appreciating it as well, and giving them not just giving them a safe, clean, secure place to raise a family. I think, and something that, to you, what you said earlier, is something that you're proud of when you go there, right? So I'm at the point now where I have two of my daughters that work with me. One of them that's come and seen that. I brought my family to see some of the assets that we've owned. I want to be proud of them looking at what we're doing. Like, why am I here? Why am I doing this? Why am I traveling? Like, this is what we're doing. And I want them to be proud of that, and the impact that we're having on the ground.
I love that, Frank. I think so often it's lost, and we're in capitalism is this ethic of America and the West, and I'm not sure that what we have right now, frankly, is capitalism. But I
a
do
whole nother
believe
story. It's a different podcast. We can have it, but
right. I mean,
how much time do you have?
Oh man, it's you know what, with the NCAA tournament's on at noon, so we got an hour. I think I do think we're missing some of the, I'll say, the heart that's important. And we talked about like financial innovation. I mean, a lot of what's going on is, I got to get rich. I got to get quick. There's a hack for everything. And, my experience in life, I can say this now, almost 50 years old, is it's the slow and steady that really produces the character formation that makes us better people. And we want to have great investments. We want to do right by our residents, right by our investors and our employees and team members. But, we have to become, I hope that we have to become better people through that process. That means admitting our failures, acknowledging our mistakes, owning those, and growing through them. And I've got 4 kids. We have these kinds of conversations. I'm not sure that everybody's having those kinds of conversations. So I don't want to get discouraged, but I hope that we can get back to a slow and steady process for character formation.
I got a quick question for you. What do you think, because there's a lot of new operators in the space, right? What do you think is going to be the number one differentiator or skill an operator is going to need to be successful over the next 36 months?
over the next 36 months, and I'm not the first to say this, but I think you've got to become excellent in operations. And you can't do that sitting behind an Excel spreadsheet or, typing something into Claude. You've got to be on the ground, understanding the nuances of the business. And I'm not saying that, you're an operator today and you'd have to be doing that same thing in 36 months, but you better spend, 3 or 4 or 5 months, really understanding process A, and then move on to process B and process C. We're really fortunate, Frank. I have a partner, Levi Jekyll, has been with us for 7 years. And, he came to me as an auditor from PwC, and he was gung ho, and he's super sharp, and he really needed some deeper experience. And you know what? He cut his teeth, fixing broken water leaks, water lines at 3 in the morning, because that's when you know where the leak is, because nobody's using water, and so you can locate the leak at 3 in the morning. And he's moved through our business, learning every phase to add to the experience that he had as a CPA. You don't see many people who've given themselves the kind of 7-year runway that he's given himself now is effectively our COO. And so I want to encourage people who are new in this space, regardless of age, that they really spend time learning the ins and outs of the business at a granular level.
I love that. So Nathan, if somebody wanted to find out more information about ARX Capital, if they wanted to find out a little bit more about your investment thesis or what you're doing, how would they find you? What's the best route for them to reach out to you?
Sure. Well, they can email me anytime, which is just Nathan@arxventures.com, which is just arxventures.com. And our website is arxventures.com. We do have a third fund. We just launched our third manufactured housing fund, and this generally stay open for, call it, 5 to 6 months. We've seeded the fund with a number of properties, another number under contract. But more than anything, I just say follow us. We want to provide education and value for folks, even if they're not investing. So they can link up by going on the web or emailing me, and we'll make sure that we stay in touch.
Nathan Jameson from ARX Capital, thank you for being part of the podcast today. This was a lot of value out there. And if you have a chance, if you're there listening, if you go to one of these seminars or conferences where you see Nathan on one of the panels, make sure you go in there and listen to what he has to say. Great conversation and continued success, my friend. This has been another episode of the MHP Exchange podcast. Until next time, happy investing.